Hi, Dominique, and welcome to another edition of The Week Ahead. I'm always enjoying talking to you every weekend and helping to deliver your thoughts and insights to our customers. But now that you're famous, I'm particularly looking forward to it.
Famous for a day. I also enjoy talking to you, Andrew, and I always admire the beautiful palm trees swaying in the breeze behind you.
I'm trying, yeah, it looks a little bit different. I've moved a bit on the beach, so. Okay, so let's kind of dive right in. It was kind of been a little bit of a tricky week because it hasn't really been like a huge amount of data or anything, but a continuation, I guess, since payrolls last Friday, especially short end rates have moved quite a bit. And that's starting to have an impact on risk in general. More equities, I guess, than kind of the dollar, but let's kind of unpack it. So yeah, what's stood out over the past week? Obviously, we've had a lot of speakers talk too. Yeah, what do you think?
So, I mean, you are spot on. Not much data. The action was really with the Fed speak. And it was interesting because on the spot, the reaction to Chair Powell's speech was not that great. I mean, as usual, people paid attention to disinflation has started and completely ignored we have a long road ahead of us. And then I think, there was some further thinking about what was meant. Also, you had a string of speakers, and they were all hawkish, even Governor Cook, who is the dovest of all the doves on the committee.
I think that's one of the things that seems to spook the market. Yeah.
And I think it's clear we are gearing up for a small increase in the terminal rate in the March SCP, which, makes sense just from a risk management perspective. Even if the Fed doesn't agree with my dire predictions, they look at the revision in the labor market data, the NFP. Good risk management suggests that they should hike a bit more, and I think that's what the Fed speeches are hinting at.
Right. But not move back to 50 at this point, just more 25s, I guess, or.
Yeah, more 25. In fact, Governor Cook said that moving in incremental steps is good, but we need to hike further. Though, to be honest, the fact that she would need to talk again about these incremental steps makes me wonder if, the hawks are not pushing back towards 50. It's far too early to say. We still have a few weeks of data and Fed speeches, but yeah, that is a risk going forward.
Yeah. So I see right now on the WRP on Bloomberg. So basically, obviously there's hikes and then cuts, but pretty much a year from now, rates will be the same or higher, is what the market's predicting. Yeah.
Totally.
Yeah.
So Chair Powell must be pleased. Now he needs to see financial conditions tighten. And in fact, one of the speakers, I think it was Williams, mentioned that, if financial conditions loosen too much, the Fed would have to hike more. I don't think this is the majority or the consensus view. But I think President Williams is getting a bit impatient with markets and is trying to shake them.
Yeah.
And the fact that we've had this strong data, of course, gives him more credibility.
Yeah. I mean, definitely kind of more, I guess, quasi-anecdotal from talking to people in the venture world and people in M&A and kind of investment banking. They are starting to have conversations for the first time in a year. They're saying like things are definitely heating up now. That may stop again, but companies talking about going public or larger kind of investment venture funds getting a bit more active. So there, I guess it is right that, you know, if inflation is, especially wages, hold at these higher levels, there isn't a ton of signs like, you know, certainly the economy's falling off the cliff. I mean, I guess in general, that's kind of ended now, that concern. Now the concern is back towards inflation.
Definitely. I mean, it's happened much sooner than I thought. In part, I think the trigger was a huge NFP number, completely off the charts. But yeah, the risk of higher growth than expected and with it higher inflation, definitely.
So obviously it's very easy to kind of like, you know, Monday morning quarterback, kind of, you know, look back. But I guess one of the things that's happening with payrolls or employment in the US is you've had all this hires in things like finance and tech and places like this, and that takes longer to let people go. But in the services sector, kind of leisure, hospitality, that's still the same or lower than it was pre-COVID, right? So obviously, if those jobs come back to the same level, then it's not a complete surprise. Are they back to, yeah.
The bottom line is that, you know, the tech industry, the financial services industry, these are sexy industries. Everybody talks about them, but they are actually a tiny share of total employment. So they've been laying off in tech, in part because they completely overdid it during the pandemic with but the rest of the economy is doing very well and is very happy to absorb the workers released by the tech sectors.
Yeah. Okay. And how do you feel about like how the market reacted so far? I guess equities, you know, the whole curve and fixed income, I guess, or the shorter end, or.
Well, I mean, that's what you would expect if people are getting worried about inflation. You know, an equity sell-off, the curve inversion deepened. I think, you know, the bond stock correlation could turn positive again because inflation is negative for both stocks and bonds. So when the macro shocks are mainly inflation shocks, you have that negative correlation, while when shocks are mainly growth shocks, growth is positive for stocks, negative for bonds. So that's when you get the negative correlation. So that correlation is, you know, is going to come back to positive, which makes sense. And frankly, I don't see much scope for data surprises to change that view. And maybe it's a good time to move on to the economics part of our talk and discuss what's coming next week.
Right. Last question. Are you surprised that, and I think I know the answer, I've asked Bilal this too, that the curve is so inverted, if especially now where the Fed's talking about going at continuing 25 basis point clips, like, and it looks like growth is probably stronger than most people had anticipated. Why is the long end not selling off more? I guess eventually, so the market's believing in the Fed, even though, you know, they will say they don't, but they're believing in the Fed and the Fed's going to do what they need to do. And in the end, they will either bring inflation back under control, or they will drive the economy into recession, I guess. I'm a little bit surprised that the back end doesn't sell off more. Are you?
You mean that yields are not lower than they are?
Higher.
Are higher. Well, I mean, no. I mean, to me, the story there is that the Fed will have to be much more aggressive to kill the economy. I think in addition, there is a little... and
they actually will do it.
And they will do it. And I think there is a further worry, which is about, you know, if the Fed goes to 7-8%, as I think, will there be a financial crisis? I think it's quite likely, but it will come after the recession. I mean, if you look at past tightening cycle, typically you have tightening, recession, and then the financial market fireworks start. So that could be another reason for the low long-term yield.
Yeah, and as like you and other people put off, the good or the bad is households and corporates are just in much better shape, much better shape than they have in any other crisis. So
definitely, I mean, superficially, a better immune to Fed tightening now.
As you've been saying for a year, yeah.
Underneath the hood, I bet you there is fragility, especially with the corporate sector. Right. But for now, I mean, look at the real estate market. It's starting to recover. Look at credit growth. It was a little lower than expected this week. But if you look at the credit impulse, so the 12-month change in credit relative to household income, it's twice as high as before the pandemic.
Yeah.
US policy, monetary policy tightening is not biting, basically.
Right. And there's a whole other stuff, kind of like we said, I guess banks are lending more, the government, certainly states are still doing some of the stimulus checks and other things. So, okay, good. So so let's move on to the upcoming week. I guess the big one's CPI, but what's your take and what do you see happening?
So CPI Tuesday. For once, I think the market is a little too pessimistic on 0.4. I think what's going on there is that people have been really shocked by the result of the Mannheim auction for used car. But the thing is, it's a very volatile series, much more volatile than used car. Also, the weight of used car and trucks is like less than 4% of the total index. And if you look at the ratio of used to new car prices, is still way above the pandemic, while at the same time, it's becoming easier to get a car. So that ratio still has downside, in my view.
More to start widening again. Yeah.
So that's why I'm thinking of 30 basis points. I mean, rounded 0.3 rather than 0.4.
0.4, 0.5, yeah.
But to be honest, in terms of Chair Powell, I mean, he looks at the big picture and he will want to see a slowdown in shelter or in core services.
Those are the ones he's going to be targeting.
And I don't think this is going to happen.
Yeah. Okay, what else next week?
Then retail sales, of course, and there I will be looking for a positive surprise or some revisions, because the consensus forecast, given the contraction, the 2 months of nominal contraction we had in November and December, the consensus forecast, in my view, is too low, given how strong the labor market is.
Oh, so you think it'll be even higher than 0.8%? Yeah. Why is it so volatile? Is there like something underlying? You have a contraction of 0.2 and 0.7 now plus 0.8, or is that it's normal that it's this volatile?
It's just the nature of the series.
Fine.
Yeah. So it's normal. And when December came out, I had put a comment on our Bloomberg chat showing that this could well be seasonality, because if you looked at the year-on-year data, especially deflated by the CPI, it was nowhere as bad as suggested.
Right. Okay. And any other big ones? Obviously, those are two big ones, but.
The rest of the week, well, we'll have PPI and import prices. There was a big increase in import prices, excluding oil, last month, and I'll be very interested to see if this was a one-off or the beginning of something new and pernicious. For now, I'm still thinking one-off. Then we have a slew of manufacturing indicators, Fed surveys, manufacturing production. The consensus expects some improvement, and that's my view too. I think the worst is behind us. And then you have a series of numbers on the residential market. And I generally agree with the consensus. I think we are seeing the beginning of a recovery in the residential market, which is a bit of a not a good thing for the Fed, definitely not what they want at this stage, but that's what the data is showing. And I guess that's the gist of it.
Okay. Okay, cool. And then political developments. I watched a little bit of that
State of the Union address.
Yes.
I have to confess to not watching it live.
I just watched some of the highlights. It was like pretty
Yeah.
bad on both sides, but anyway, certainly they're one side, but definitely, you know. But to be fair, Biden was hanging in there.
Well, that's it. I mean, in terms of immediate political agenda, nothing is going to happen for the next 2 years because of the House being controlled by the Republicans. And to be honest, by mid-year this year, all eyes will be on the primaries. So where the State of the Union address was interesting is that it could have been the unofficial start of President Biden re-election campaign. So it's going to be an interesting election season.
Right. Right now, it looks like it's just him, right? I mean, obviously there are other people, but right now, it doesn't look like the establishment is aggressively putting forward somebody else.
Yeah, I mean, American people are not all that chuffed by the prospect of another Biden candidacy. I mean, that's what the polls are showing, but I mean, he's clearly forging ahead. It will be interesting to see on the Republican side if they can find someone else than Donald Trump. Then I think the race could be really competitive and interesting.
Right. I know your friend Matt Stoller. You know, he I think really has been impressed by all the stuff that Biden has gotten done.
So, yeah, and perhaps that's something we could have mentioned, the antitrust lawsuit against Google. It's really big news. I mean, it's like the lawsuits against Microsoft.
Now Amazon, I think, as well. You know, different topic, but you know, I can see both sides, but you know, these are some of the biggest employers in America, you know, and some of the strongest companies in the world. I'm not a lawyer, I don't know that. But I guess the politics more around the debt ceiling. Do you see any progress, or do you continue to see like minimal progress until the push?
Nothing is going to move until we are in the last few weeks or so, and then we will have the usual, you know, lamenting, brinkmanship. How can you cast doubt on, you know, the willingness of the US to pay its debt, blah, blah, blah. And then they will make a deal as usual.
Right. Okay. Awesome. Well, as we always like to do, just quick highlighting of some of the big pieces. Let's start with Pro, I guess. We did have a few clients actually even asking. There's your piece on why you think the Fed will bring quantitative tightening to an end in the second half of this year, which is kind of surprising, I guess, considering that you view that rates will have to go higher. So that's an interesting thing that certainly our Pro clients should, or interested potential Pro clients should definitely look, you know, check out or reach out to us to understand more. Bird had an interesting piece on receiving focus on rates in India. Why we think that's a good trade. By the way, just a quick, I guess, shout out to all the researchers. The model portfolio has gotten off to an awesome start this year, which has been amazing. And Bilal kind of did some tweaks early in the week, which also looked like they could be quite good tweaks, especially good time on dollar yen, coincidentally. Our new colleague and part of the macro family, Mustafa, wrote a cool piece on the rates weekly and how to trade the uncertainty in the market. I think, Dominique, though, you would probably say there's no uncertainty. It's clear what's happening.
There is always a lot of uncertainty.
I know. Okay. So he had some cool trades on Prime or Light, and certainly Light can always kind of, look to upgrade to Prime. There's the crypto index tracker as crypto comes under pressure once again, and trading as kind of a high beta asset. SAM, which I've been kind of looking through recently, kind of going back in for people who haven't, is Sam's super cool pieces on the deep dives. This one was how to best use NLP analysis in finance. And then Ben did his flight tracker, which I think there's a lot of people have been trying to analyze the flights in and out of China and where those volumes have been picking up or if they're picking up. And that kind of is one of the things we're considering or think about when we talk about inflation and energy prices. Obviously, these are all components of kind of or secondary effects of the China reopening. That's it from my side. So any parting words or?
As always, good luck, and please get back to us with any feedback you have, and critical feedback is actually the more helpful.
Awesome. Cool. Have a very nice weekend and good luck, everyone. Yeah, I don't know if we're going to do, maybe somebody might have to step in for me because I'm away next weekend, or maybe we'll figure something out. So, okay, cool. Good luck, everyone. Bye.
Bye, Andrew.